Hey, good morning. Welcome to Thinking is Contagious. Hope that you've enjoyed our broadcast up till now. We're going to go a little bit different today. We're going to go a little bit into money, the stock market, what's going on today in our economy. You all are aware that the markets have rebounded in the face of the pandemic, um, contrary to what most people expected. One thing that I can tell you, I've been involved in the markets uh, for a long time. I've always liked the stock market. I've always liked equities. Can't tell you that I've done well, real well on them. I haven't. So full disclosure there, I have gotten much more involved in it in the last year and have improved my performance. And I can tell you the secret to doing well in the stock market or doing decent in the stock market is to do homework. And there's no shortcuts. But having said this, uh, I can also tell you that it's increasingly more difficult to do that homework. It's increasingly more difficult to do the due diligence, as is evidenced by these stock pickers. I mean, these guys have no idea. And I'm not saying this in a negative way, but you can't predict this market. And these pickers and these guys who have their own TV shows, you know, they're lucky if they're hitting 50%. I read somewhere, have not verified this, by the way. Okay, so probably should before I say it. But anyway, I heard somewhere that even Jim Cramer, who's all over CNBC, is got 50% success rate or slightly below 50% success rate. And again, it's not disparaging against him. It's not disparaging against anyone. I just think that the markets today have very little to do with economics, bottom line, uh, profit and loss, balance sheets. I think it has very little to do with that. It has more to do with projections, growth, momentum. These are all buzzwords today. Um, and it makes it difficult. It makes it difficult, but there are some people that are really, really at cutting edge as the market takes a new direction. And we'll get into that a little bit. My thoughts. These are my thoughts. Again, I'm not an expert. I'm going to talk about stocks. I'm going to talk about the stock market. I'm going to talk about investing. And I will tell you this: you shouldn't invest with you shouldn't invest any money that you're going to need immediately. And immediately, I mean, if you think you're going to need the money in the next 3 years uh, or sooner, I would not be in equities. I would be more conservative, even if you're yielding nothing. Um, you know, keep keep yourself a 3 year buffer in cash. Uh, Make sure you've got your debt under control. Make sure that you're not living above your means. Buy a house, I would recommend. Buy a home before you invest in equities and the stock market. After all things are done, if you've got some money that you're not going to need, I honestly, sincerely believe that if you've got a 10-year plus window before you're going to need that money, you would be very well served to put a portion of those assets into equities. And I think that a piece of the equation that gets undervalued a lot, and I really wish that I had paid attention to it 25 years ago, which I didn't. Always, I was always of the theory looking for the big hit, which I think a lot of us do. Turn 1,000 into 10,000, turn 10,000 into 100, turn 100 into a million. That's what you know my pursuit was, and I can tell you that it leads to a lot of churning, a lot of in and out, a lot of snap decisions that with patience you do better off. You'd be better off. I think the key to investing is if you're going to get a long-term investing is you do look for a good balance sheet. You look for a company that's making some money, that has a good product. And there's a couple of points with the product that's very important, and I'm going to reference Warren Buffett a couple of times here, but one of them is what he calls a moat. and that being a high cost to entry as far as a competitor is concerned. So that's an important point. When you get a product that has a good moat around it, it means that for somebody to come in and compete against it, it's not easy. It's financially not easy. It's logistically not easy. There's different types of moats that can be had. But if you find the moat, that's an important one. Number two, if you find an equity that pays a dividend, yearly dividend, you may hear, oh, it pays a 3 or 4% dividend. You go, no big deal. If you accumulate those dividends, reinvest, you buy a stock, you put it in a reinvestment format where every time a dividend, every quarter, every 3 months when they send you a dividend, you reinvest it in shares, you will be surprised at what compounding does, and you will make a lot of money. And I take right now as an example here today, July 27th, and I'm not touting the stock, although full disclosure, I do own it. You look at a stock like an IBM, it's at about $125. It's paying a 5% dividend yield. If you take that stock, and more importantly, they are in a transition from that stoic, big blue, conservative company to a more modern technology-based company going into things like blockchain, which I think is phenomenal for future investment, cloud computing. They have become involved, and they're morphing into a more modern, lean, mean company. So you take a stock like that, gives you a 5% yield by the rule of 72, just on the yield on the 5% dividend alone, if you reinvest it, you double your money in about 14 years. I know that doesn't seem sexy, but you get any appreciation, you reinvest, you're going to do well. You come out ahead, you do very well. I'm going to tell you why I chose this topic today, and it's because, I watch CNBC quite a bit, and they, in my opinion, are the leaders. They're the best when it comes to following the financial markets. I'm not a fan of NBC and their liberal stances on things, but got to give the devil his due, and I think they cover the markets better than anyone, more thoroughly than anyone. But I've been watching for about a week and a half now what I believe is an agenda, which is to drive down the prices of the large cap tech companies for 2 weeks. All they've been talking about, it's a bubble, they're overpriced, look out, the sky is falling on Apple, the sky is falling on Microsoft, Netflix, Amazon, Google, Facebook. And they've been successful over the last week and a half, driving down the prices a little bit on all of them. And I think what it does is the big guys, the big dollar guys are just jumping in and buying it. Kevin O'Leary, Mr. Wonderful of Shark Tank, was on CNBC today, and he was really harping on that point, saying that on the dips, he's buying all of them. And I'll tell you why. The stock market, money management in general for people that was done 5-10 years ago involved a portion of your assets in equities and stocks and a portion of assets in fixed income, bonds, municipal bonds, corporate bonds. And that was called a balanced portfolio. And that was smart, diversified investing. However, that portfolio was able to work, and that was a feasible portfolio because you had yields on bonds that were not like what we have today. Today you have a 30-year treasury at less than 2%. You have a 10-year treasury at 0.6%. No one's going to tie up money long term. Not anyone who needs to grow capital is going to tie up money long term in those kind of instruments. Therefore, what has happened is that these money managers, in the pursuit of yield, have gone from portfolios that used to be considered 60% equity, 40% fixed. They've been forced to go to 70 and 80% equity, 20%, 30% fixed income, because of the fact that they're seeking yield. They're seeking income and growth for their clients. And the only way that they can perform and beat markets, is by more closely mimicking the equity piece, following the equity markets. And that's what's happening. So that is also the reason why you're seeing the stock market, one of the reasons you're seeing the stock market run up, because those dollars that would have gone into fixed income are suddenly going into equities. In addition to the fact that the Fed has flooded the market with money, that money is seeking equity, is seeking yield, return, and people are investing. So the natural target is people are going into equities. Will there be a correction in equities? Absolutely, because of what we just discussed. It's artificially creating a magnet for capital, because there's nowhere else to invest. So as soon as you see interest rates start to go up a little bit and yields start to change, that equity market's going to get hit. However, there's one piece that I argue will not be hit, and that's technology. We're in the middle of a technological revolution, like the Industrial Revolution. The basic technology of companies like NVIDIA, Microsoft, to an extent IBM, Apple, Amazon, Google. There's many of them. I don't have them all in front of me right now. When you find companies that have strong, bulletproof balance sheets, that are making money, that have hordes of cash in the bank, and have cutting-edge technology, that is the future. That's not going anywhere, in my opinion. That's where you bank. That's where you put in the money. And that's why you're seeing what people are calling ridiculous valuations for Apple, for Facebook, for NVIDIA, for Microsoft, for whatever. You're seeing ridiculous valuations that are many multiples beyond what is the norm, that was considered a safe haven of price earnings in the past of 16, 17. You're seeing price earnings of 20 and 22, and it's a norm. And it's not that it's inflated at this point as a number. The number has been created, the return, the multiple exists as high as it is today for one reason and one reason only. It's because there's nowhere else to get the yield. So at a 20 times multiple, your yield is better. Just at a 20, at a 22, at a 25 times multiple, your yield is better than what you're going to get on a bond. And that's why the capital is going into these things. So stock market is a place to put some money. Like I said, not money that you need right away, not money that comes before making sure that you got a home, that you're able to pay your bills. When you have some discretionary capital and you say, I want to stock this away for my retirement, I think it's a strong vehicle, and it's a strong place in which to place some funds. Hopefully this is something that you find informative. Full disclosure, a lot of the stocks that I've mentioned here in reference and going, I am invested in, but it's not a recommendation to buy. Do your research, and remember, thinking is contagious. So catch it, hit the subscribe button, and join us on the next one. If you enjoyed this little bit of deviation from the norm, I would like to hear it. If you didn't, I also would like to hear it, to avoid it in the future. But think and hit that button, subscribe. Thank you. Have a good day.